Yeah, sure. First of all, I would like to greet all of the attendees. Welcome to this webinar. Tonight it will be the last episode of this long series we have been going on for 3 months, and it is always hard to end something which has been going on for so long, but it will definitely be a very interesting episode as we will be talking about iceberg orders, which is something which I guess many of you know already about. And we will also talk about a very interesting feature of the Volbook software, the heatmap software we have introduced for a couple weeks ago, about the which is a special plugin which allows you to detect actually iceberg orders. So tonight we will be going through what an iceberg is, what an iceberg order is, and then we will talk about how to handle icebergs, but first of all, how to detect them. So it will be, I hope, an interesting evening. Let's allow a few minutes for everybody to attend the webinar. I am gonna share my screen meanwhile, so we can have a quick overview of what the S&P 500 is doing today. And in this way, we can also recap some of the things we have been talking about over this entire series of webinars, because today it has been a really interesting session. As you can see at the first sight from the volume profile, the daily volume profile, we can see that we have a multi-distribution shape. So basically we have lots of auction areas. POC is exactly roughly at the middle of it, and we are trading right now in the area of the POC. What does that mean? Normally, the multi-distribution profile represents a trending day. In fact, today we have been starting the session with a strong, nice up move. It reached a previous level of resistance. To be honest, can you see this level, this orange line that comes from the market profile? That was a previous value area of a market profile of August, if I remember that right, because we are trading back the levels, the old levels we have been trading in August. It slightly missed it for a couple ticks, basically 1 point, and then starting retracing back. And in this case, that means that all of the trending structure was rebalanced. And in fact, it is what we are expecting for the rest of the session today. At the same time, we can see that once we add the this move to the downside, we have touched another interesting level here. This one was slightly missed as well, but we always have to consider those levels as areas, not exactly lines, like areas. And then we had this last pullback on, and this one was perfectly to the tick, touched and rejected. The interesting thing, which comes exactly in combination to the topic of today, is that on this last pullback, we had, I promise that wasn't done on purpose at all, but apparently market is helping me, providing the best example so I can show you. exactly here on the last pullback, it gave us the indication of a nice buying iceberg. Exactly here. How can I tell there is an iceberg? There was a nice iceberg here. More precisely, a buying iceberg of roughly 1,000 contracts. Because the indicator is telling me. But before talking about the indicator, let's go through what an iceberg is by a technical point of view and also by the point of view of market microstructure. Iceberg is a very common type of order, which is used by large traders. Okay, so it depends by the market, actually, you are analyzing. But in futures, in the futures, normally is a type of order used by institutionals, large traders, uh, because let's say in general, in overall, people, traders trading big quantities. Okay. The thing is, though, and that differs from, for instance, stocks market, because in stocks market, uh, iceberg orders are a little bit more popular also for retail traders, because, for example, if you have the price of a stock being very, 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 very low, also a normal retail trader can decide to buy 1,000, 2,000 stocks. Okay, so at a low price. But normally, when it comes to futures, every time we see an iceberg, we can be quite sure that orders is driven by a large trader or either an institutional trader or a fund or something, let's say a professional trader. Okay. Uh, Basically, in a nutshell, what what's an iceberg order? It's a very large order, so let's assume somebody decides to buy 1,000 contracts. Okay, I'm drawing that in green to show that's a buying iceberg. And it is always a passive order. Okay, so being that a passive order, normally that would be placed on the order book, right? If the iceberg wants to buy 1,000 lots, that order would be placed in the bid column on the of the DOM. The thing is that if you really are trying to buy, if you're willing to buy such quantity, that order will be outstanding on the order book. Let's have a look at what the order book looks like right now on the S&P 500, and we can see tick by tick we have an average of 100, 129, 140, 184, 230, but nothing comparable to 1,000, not even 800 or 900. So let's imagine having a 1,000 quantity being placed on the order book. It will be outstanding, okay, compared to the all of the other levels, compared to the average of what the liquidity is. So what will it be the first thing other traders would think looking at that orders? Oh wow, somebody is buying 1,000 lots here. So if I go long somewhere here, I have a protection, first of all, provided by this huge quantity being there and waiting to be filled. Okay, and on the other side, the bias will be large traders are looking to buy. So if I just follow them, I can earn money. Okay. Well, unfortunately, uh, that wouldn't help the people using this kind of orders for two reasons. Because if they really want to go buy, if they're really willing to buy 1,000 lots, first of all, they would need 1,000 sellers. And of course, nobody's gonna sell by looking at that. Okay, if you have the evidence of that kind of order, you're not gonna sell, not at all, not in front of a support like that. And on the other way, all of the people looking to buy will be trying to buy according to this big order in front of them. Because if I want to buy, and I want to buy here at this very same level, so I place a tiny one lot pending order right here, that means that it will be the last of the queue. So my order will be executed after these 1,000 are executed. So if I am willing to execute on the upside, the smartest thing I could do is trying to get an execution maybe one or two tick worse than that, but in a level of the book which is not that crowded. So the best solution for these two issues, of course, is hiding part of this order. So I want to buy 1,000 lot. I decide to, if I am using an iceberg, to make only 100 visible in the order book. So it wouldn't show that there is an outstanding amount of contracts. Okay, but the entire order is 1,000. So what about all of the other 900? Well, those will be hidden. That's why this kind of order is called an iceberg, because exactly as the iceberg being in the ocean, the biggest part of that order is below the sea level, so it's hidden. What you can see is only the minority of the entire order. But now the question is, how is it possible for me, institutional trader, I want to buy 1,000. How can I buy 1,000 by only making 100 being visible? Well, normally, let's say, to keep things simple, of course, but well understandable, uh, iceberg orders are managed by algos. So most of the people using iceberg orders, those orders will be managed by software, quickly adding orders, erasing or deleting orders in microseconds. So it's not doing manually, but basically what this softwares of iceberg management do is, once those visible orders are running out, and why are these running out? Because if those are in the bid column of the order book, their counterpart, they will be executed against sell market orders. Hitting the bid, right? Those orders will be the counterpart of this portion of the iceberg. So slowly, those 100 orders will become 80, 20, 15, 7, 3. When these orders are almost at the end, the algo managing the iceberg orders will do what? Will add an additional 100 orders right here. So all of the aggressive sellers start to realize that the wall against them is thicker than what they thought. They are adding up contracts. And basically the process goes on until all of the orders is filled. So once these 100 contracts will be consumed by counterpart market orders, there will be another portion being added, 100, 100, until the entire iceberg quantity is completely filled. This process, the one with the yellow arrows, is called reloading. Because basically what the iceberg does, and that's actually the way we can tell that the entire order is hidden, the majority of that order is hidden, is because it's not a ghost order, it's just a portion of that entire order which gets reloaded in the order book piece by piece. And normally, of course, how many contracts are involved in the reloading process may vary time by time, iceberg by iceberg, but let's say roughly for the S&P 500, this is a good example. Normally, they would reload 100, 150, 80 contracts. Now, the thing is, what's the benefit of doing that? First of all, nobody would realize, yeah, maybe you can tell, especially if you're looking at the order flow, there is something wrong with price. Why? Because you're going to see lots of aggressive sellers. Oh, sorry, yeah. You're going to see lots of aggressive selling going on here, which will affect the delta of the area, because all of this aggressive selling leaving a footprint either in the footprint chart and in the cumulative delta as well, in the delta to the single bar as well, in the delta profile. As we said, delta measures all of the aggressive sellers, all of the aggressive trades going on, on a specific area. But actually, we can't see price moving according to that delta. On the other side, if we also look at the order book, what are we meant to see when the reloading process is going on? Normally, we will see, let's just freeze that for a moment so I can make the example. We're going to see, for example, 144 here. We can see the level being traded. Delta is going to increase to the downside. We would see that 144 is going to decrease, slowly decrease. But then at a certain stage, those will become 50, 20, 10, and so on. And suddenly we are going to see 120 again. And price will be still standing there or moving very, very slowly from the area. Maybe one tick above, one tick below. That basically is the very same dynamic of absorption. Exactly the same thing as a ordinary absorption. In fact, Iceberg's order normally use the principle of absorption to execute their orders. They just absorb the market. The only difference is that, of course, is this is a massive absorption made by huge volume. But apart from that, Iceberg would just create absorption. That's it. So exactly what we have been talking about in terms of absorption, either in the footprint, either on liquidity. And of course, since those orders are hidden, where they aren't really hidden, they are managed according to this structure, most of the times we can just see liquidity providing the reason for that absorption. In fact, in many cases, Iceberg order will show like a huge bubble rejecting price, but which is not hitting on a specific liquidity level. So yeah, according to what we said the last time, we can definitely tell this is an absorption. It is. But how come it didn't hit a specific level of a relevant level of liquidity and it got absorbed anyway? Well, apparently because there was that liquidity was provided in that level, but it was hidden. Or even better, liquidity wasn't there as price approached the area, it just increased as price was trading the level. That's the reason why we don't see, in most of the cases, a liquidity bands. Sometimes, yeah, we could also have the evidence of an iceberg and also with a confluence of a liquidity area like this. But in this case, in order to detect that this process was caused by an iceberg, you need the indicator, which I'm gonna introduce in a little while. If you don't have the indicator, by just looking at this and see a strong price reaction, not hitting on anything specific, it's a very good way to assume. Of course, you can just assume without indicator. There, there, there was an iceberg there. If you're looking at a heat map, if then you read the DOM and you can spot the reloading process here on the corresponding column of the DOM, then of course, yeah, that's a more reliable way to detect icebergs by yourself. Of course, the stop iceberg indicator, like the one provided by Volbook, it is even more reliable because how does it work? And how can it detect native icebergs with an accuracy of 100%? So that means if I have the indicator showing that that's an iceberg, I have no doubt that that was an iceberg order trading here on the buy side. If I try to detect them looking at the order book here, if I look at the liquidity which is not being hit, I can only assume there is an iceberg, but I can never have 100% accuracy like with the indicator. Basically, the indicator does what? It is an algorithm chatting with the MBO algorithm of the CME exchange, according to which every order transacting the market needs to have an ID number. And normally, the iceberg orders, all of the partial orders combined into the main iceberg order, they come with the same ID number. So in this case, the algorithm is able to recognize that a reloading process is driven by an iceberg. And with 100% accuracy, and not only that, it is also able to count how much volume is involved in that iceberg. That's another very interesting and useful information, because let's make the same example using a footprint chart. Okay. The previous low, the previous swing low, was traded here. And we can see that there is a huge amount of aggressive selling delta, which after was absorbed and drove price back up. If we look at the number, we can see that the bid value here is 1.8K, okay, of aggressive sellers being involved there and apparently not being able to push price down. So they were absorbed. Okay, cool. Is the iceberg, can we tell the iceberg is 1,800 volume? Well, not really. I mean, yeah, it could be, but this is only the counterpart, which means apparently that's another one. We have a new alert of an iceberg buying. Look what happens. Huge bubble. Look at the reloading here. It never goes down. 30, 50, 85, 86, 140. Did you see that? And of course, we have a huge bubble apparently being absorbed. At the same time, we have a nice peak up of the indicator telling us, by just looking at the cursor, how much quantity was traded in the iceberging mode. Of course, this is different by the total volume being traded here, because on that level, there could be also different orders by the iceberg. We want to have the information of how strong the iceberg is. Because let's talk about something really important in terms of iceberg. Not iceberg orders are used in many situations during many sessions. Not all of the iceberg orders are reliable enough, because there are so many trading at any time, in any market, in any situation. In fact, if I just zoom out here, we can see that most of the times this line is flat, but we can see there are some minor peaks here. One is to the downside, another one on the downside, and those two are really outstanding here compared to the past. If you want to consider icebergs in our trading, we only have to consider those above a certain threshold. This threshold, of course, depends by the market we are looking at. For the S&P 500, personally, I don't consider at all any iceberg below 500 lots being involved. I just ignore it. Even if I am trading short, and I have maybe 200 iceberg buying, I would just ignore it, because it's not involving a relevant quantity being able to affect the market. Of course, if we want to find a threshold for thinner markets, like for example the Nasdaq, we have to go lower. On the thinner a market is, the lesser contract we need to be involved in the iceberg in order to affect market. For example, for the Nasdaq, 150 is enough. So that's for the ES, that's for the NQ. Markets like the crude oil or the gold, over 200, they are slightly thicker than the Nasdaq, but still thinner than the ES. So a threshold is mandatory. Of course, it has to be a threshold which makes sense for the instrument we are trading or we are looking at. Now, how can we read this indicator? Every time we have a peak above the middle zero line, the curve turns green, and every time we have a peak below the zero line, the curve turns red. A green peak would indicate a buying iceberg. A red peak to the downside below the zero line will indicate a selling iceberg. And by just placing our cursor, well, it will just indicate the amount of the volume being involved in real time. But if you want to also assess an iceberg which has been taking place in the past, we can just move our cursor to the top of the peak and see how much volume was involved. For example, in this case here, we have 974 contracts being involved in the iceberg. So we are almost twice the threshold. So definitely that's an iceberg we can and we have to take in consideration in our trading decisions if you want to trade that situation. Again here, it's even stronger, 1,300. Very important thing to do, every time we see a peak, we should better locate the area of the level of price where the iceberg has traded the most contracts, which is quite easy because if we just put our cursor here at the top of the peak, we will notice that the peak always correspond to either a big bubble on the other side, so that's an iceberg buying. We need to see a huge red bubble, because of course that bubble will show aggressive traders, aggressive sellers being the counterpart for the iceberg. And that's basically, we can consider that the iceberg area. Same thing here. Top of the peak, here's the bubble. In some other cases, we can extend this area where you can see the group of the biggest bubble trading in that area. So in this case, also drawing and tracking the area where the iceberg has traded can be slightly extended like that. So after detecting icebergs, what's the best way to trade them? Of course, there are many ways, but let's destroy first a myth. An iceberg, it doesn't mean that a market is gonna, a buying iceberg, like in this case, doesn't mean that market is gonna climb 100 ticks after that immediately. Not at all. Iceberg can also be broken, like it happened in this case. Why? Well, first of all, there is an issue with iceberg. The iceberg type of order is just a type of order which big traders would use to have better executions, right? But are we able to know if that iceberg is used to enter a position or to exit one? It makes sense. Here somebody's buying. Are they buying because they want to enter a long position? Or are they exiting, maybe with a partial profit, a short position, which they have previously taken? The harsh truth is we don't know, and probably we will never be able to know that. But there are some ways to tell if the iceberg area is being defended. How? First of all, we need to carefully check the way iceberg interacts with market. So straight after that iceberg was launched, what does market actually do? Does it really go in the direction of the iceberg, so in this case buying? And if it does it develop a nice initiating move in that direction? Well, if the answer is yes, that means that the iceberg is being defended. So that's my personal way of assessing and eventually trading icebergs. That's a first yellow light. If the iceberg is defended, I also wait for a final pullback in roughly the area of the iceberg. And if on the pullback I can see that in this case sellers saw the aggressive traders going against the iceberg are exhausted, small bubbles, small red bubbles, and then buyers are picking up again, in this case for me it's a green light. But for instance, there are also more aggressive traders entering, executing on the iceberg immediately, because this kind of execution here, as we saw in the second example when I was showing you, even if it was quite fast, but that buyers were actually reloading from the iceberg level, aggressive entry would provide a very tight stop loss right behind the iceberg. And even if you get stopped out, your stop loss is going to be really, really tight. And if then market takes off from that iceberg, you can have a very interesting risk to reward ratio. Personally, that's more aggressive. Personally, I prefer being a little bit more conservative, and even if sometimes I might miss the move. And basically that applies, I would say that applies the most if you are looking for proper swing trades. If you're just scalping within the iceberg areas, I would say the aggressive approach would be more rewarding, even if you have to take into consideration that you might be stopped out more frequently, but your stop loss is going to be really, really tight. So after looking at the way iceberg areas are normally defended, why sometimes they are not? The main two reasons are either the iceberg is to close totally or partially a previously taken position, so there is no interest to defend the area where that iceberg was launched, which makes sense. Let's assume we have a huge position, a huge short position being taken somewhere here, okay, of 2000 lots, okay. I am closing 1000 here. As I'm still in with 1000. Will I back the move to the upside? Of course I won't. On the opposite side, I would do my best to break this area, and if I have the power in terms of money to do that, I would do my best to break this area and reach my second target, maybe. Or else, even if I am entering a long position, but I am a large trader, of course I can't demand to enter with 3000, 5000 lots all in one single area. I will have to split my entries through different zones. But definitely, it will be convenient for me buying maybe 100 here, well, sorry, 1000 here, 1000 here, and maybe an additional 1000 even more cheaper, even cheaper. If I am buying, I am accumulating on downside moves. Of course, that implies adding up to a losing position for those people using icebergs. That it makes sense. If you have a relevant budget and you have to trade with relevant number of contracts, of course you don't have to place your 10-tick stop loss like us retail have to do. So this is something which is widely done among professional traders, okay, and large traders. That's why it is always important to, another reason why it is always important to detect when we have an iceberg area, see how strongly that gets defended. Like in this case, because here we would have had a very nice trade to the upside. Might look a short move from here on, but we're talking about roughly 5 points move. Yeah, there are better moves, of course, in the S&P 500, but that's already, it could have been a very nice trade. And in this case, we would have avoided. We could have avoided the stop loss by just thinking at the iceberg area in that way, because we had a first attempt to go back up. And we have analyzed that in real time on the reloading they were making here on the bid column of the order book. That could have been a really nice scalp of a few ticks. But if you're looking to trade a wider move, of course, the iceberg area, they always need confirmations. With a nice move initiating in the favor of the iceberg, and then on the pullback, assessing the entry. Of course, by assessing, I mean whatever else it can confirm you that that area is not trading with an iceberg anymore. That's why we need an exhaustion here on the pullback, specifically an exhaustion. An exhaustion would mean that, first of all, there are no more aggressive traders trading against the iceberg, and also market gets away from that area quite quickly. At the same time, that also means that the iceberg is not refreshing anymore, reloading anymore. So apparently, it must have been done. It has been entirely executed. Then there are many different patterns which can develop around the iceberging patterns. Because, for example, when an iceberg gets broken, like in this case, in some other cases, market will drop, like in this case, and at a certain stage, we will see, sometimes, of course, it's not the holy grail, but many times we're going to see, as market continues down, another iceberg. Okay, which in this case, it gets defended by a nice initiative move to the upside, and then it gives us the perfect setup, still based on that pattern. And in this case, assuming we want to take the trade, That means they are defending the area of the iceberg, but they have been buying from here on, then continued here. So if this area gets defended, the probability to get back to the area where the last iceberg was provided, even if it was broken, is really, really high. And the evidence of traders, also aggressive traders defending the area of the last iceberg, it could be the final clue that their accumulation plan is over. They have bought all what they were willing to buy. And so now we are ready to go up. And of course, the levels where previously icebergs were traded are the first targets of those moves. The first middle stations, let's say. There is a question. Hi, Ivan. The minimum contracts to be taken into account for considering the icebergs. For the S&P 500, I'll just write that down. So for the S&P 500, I would recommend 500, not less than 500. For the Nasdaq, 150. Crude oil and gold, 200, 250. Whatever is less than that, we can just ignore it. Then, of course, it's quite rare. It's quite rare, but sometimes we can have massive icebergs, like, for example, 3,000 on the S&P 500. When this kind of iceberg happen, the counter move tends to be really aggressive and immediate. But situations like that are not frequent at all. They may happen maybe twice in a year. For the Nasdaq, 600. That's outrageously high compared to the threshold. In this case, we can expect with more probability an aggressive counter reaction, but those are really not frequent at all. So it's not something you can really rely on every single day. Okay, guys, that's it for tonight. Please let me know if you have some questions about this all. Just to, if it can, if it can, yeah, sorry, if it can be helpful, in order to use and to have available on the platform the stop iceberg indicator, you need to have first of all the MBO plugin to be enabled, which is an extra add-on if you are subscribing to the platform. Um, you need to have the MBO plugin being activated, which is yeah, it comes with an extra cost, but is something like $15 per month, so nothing too much. And this is very important. MBO plugin is able to communicate only with exchanging, providing actually the native MBO algorithm, which at the moment is provided only by the CME, excluding the currency futures. So you can't have that available on the Eurex instrument like DAX, German Bund, uh, Eurostox 50. Unfortunately, Eurex exchange doesn't provide MBO algorithm. So even if you have the platform with the MBO plugin activated, of course, unfortunately, it won't be able to communicate with the exchange. So you will just have a sad flat line right here. And among the CME instruments, it is available on them all, with the exception of the currency futures, basically. So the euro future, the GBP, the Australian dollar, but for all other uh, instruments in the different compartments of CME, it will work on everything. So on the S&P 500, on the Nasdaq, on the Russell, uh, crude oil, gold, CBOTs, whatever. Except all the exception is for currency future. Ivan, is this indicator available also in ITAS? I would say yes, but mm, I'm not I'm not 100% sure. I would say I am 60% sure. So I've read something like that, but to be honest, I don't know that well. Okay. So yeah, we said that. Anyway, Eurex exchange has made the announcement a few months ago that they are working to make the MBO available also on their instruments. So maybe in a few months there will be this extension also on European futures. Uh, you can see the contracts by just placing your cursor, your indicator, at every relevant peak to the upside or to the downside compared to the middle zero line. So like in this case, we have this nice peak here, and the indicator turns green because it's showing you a buying iceberg. And if you just measure with the cursor the top of the peak, it will give you here on the right, you can read 1.4K, and that gives you the number of the contracts involved in the iceberg dynamic. Okay, guys, I think that's all. That was the final episode of this series of webinar. Tonight we have I've seen together the most advanced concept that at the current state the technology helps us to have in terms of uh, tools to decipher the order flow and yeah, icebergs and liquidity. And I really hoped you enjoyed all of the episodes. For me, it has been not only a pleasure but an honor as well to introduce these kind of topics, which are still kind of new uh, in the trading, in the world of of retail traders. It has really been a pleasure. I was really honored to have also many questions, also many people attending, and also many people watching the recording on YouTube. So it was really a pleasure. Um, just because it's the last episode, I would like to make a very quick presentation of my website. But just because maybe some of you will have, maybe we want to go deeper into some of the topics, I provide um, complete complete education path on order flow and volume trading. So if you want to know more, if you want to, or just you want to write me an email asking for something about the topics of the webinar, you can go on volusiatrading.com/en, or otherwise just change language here, and then you can find all of the information you need. If you want to contact me, that's the dedicated page, and I will be glad to give you an answer.
That is great,
So
Edoardo. And actually, you can drop here as well on the Q&A your email address, just in case anybody has a question. And great as
yeah,
well for sharing that. It was an amazing series, truly educational, and I would really like to thank you for that one. I heard loads of things for the first time in my life, and it was a pleasure observing and learning from your webinars, Eduardo.
thank you, Alex. I have to thank you as well, you personally, and you, the Trading Pit, for this fantastic opportunity. I hope you all enjoyed that, and maybe in the future we will have the chance to do something similar. Why not?
Of course, of course. In the end of the day, we're sharing the same passion for education. So for sure.
Okay, so I wrote down my email address in the chat.
Great. The email address is there. Make sure everyone write down the email of Eduardo, and it was very nice of you showing as well your work and how people they can contact you.
Okay, yeah, should be
Great.
all right. Okay, so thanks again, everybody, and enjoy your trading.
Thank you very much, everybody. Thank you, Eduardo. You have a good night and a good rest.
Cheers, you
Bye
too. Bye
bye.
bye.